Hello and welcome to session 23 of Direct Tax 2, 4th semester BCom of Mangalore University. Now in this particular session, we are going to learn a very important concept, and that is understanding the format of calculation of income from business. What is the starting point? What are the amounts to be added? Which are the amounts to be deducted, resulting in business income? So understanding the format of business income is very important. So let's look at those items to be added, items to be deducted. So computation of business income. Now, basically, we begin with profit as shown in the by the profit and loss account. If in case the problem shows a loss, then we will be writing such number in brackets. So profits as shown by the profit and loss account will be recorded as the starting point. And if the end result given in the profit and loss account is a loss, then such value will be recorded in brackets. Now, which are the items to be added? To this profit, we are going to add expenses which are disallowed but debited to profit and loss account. So there are many items which are disallowed as per the income tax rule. And if such items are debited, meaning to say because of such expenses the profit has come down, then such items which are disallowed will be added back to profit. So expenses disallowed but debited to profit and loss account will be added. The second point that will be added is expenses allowed but debited in excess. Let's take one example. Depreciation is a regular business expense. It's a non-cash expense. Suppose the depreciation debited to profit and loss account is 35,000. And the adjustment in the problem says allowed depreciation under section 32 is only 30,000 rupees. So debited to profit and loss account is 35,000. Allowable depreciation under section 32 is only 30,000. It means 5,000 excess depreciation has been debited. When we say excess depreciation or excess amount has been debited, the profit is going to come down and the tax will also decrease. So for that reason, how much is the excess amount debited? Expenses allowed, but it is debited in excess, such amount will be added to profit. The third is taxable income earned, but not credited to profit and loss account. On the credit side of profit and loss account, we get incomes. Suppose if there is any business income and that business income is not credited to profit and loss account, meaning to say the end result profit would be less. To correct that, any taxable income, taxable business income not credited to profit and loss account must be added to the profit balance. Next thing is undervaluation of closing stock and overvaluation of opening stock. Understand this. When you undervalue a closing stock, the profit will decrease. When you overvalue a opening stock, profit will decrease. So because of undervaluation of closing stock, because of overvaluation of opening stock, the profit has come down. To correct it, such amounts will be added. So these are the four items which will be added. Expenses disallowed but debited to profit and loss account. Expenses allowed but debited in excess. Taxable income earned but not credited to profit and loss account, and undervaluation of closing stock and overvaluation of opening stock must be added. So these four items will be added and you are going to add it to profit and loss account. Suppose if the starting point was a loss, so this would be minus value, this would be plus value. So you will get plus or minus as the case may be in the problem. Then we go to the list of deductions. On the credit side of profit and loss account representing incomes and gains, there may be exempt incomes. For example, dividend from Indian companies is an exempt income for this previous year. Suppose if it is credited. If it is credited, the profit shown would be more. So to correct it, such exempted incomes must be deducted. Second, incomes which are credited, but those are taxable under other heads. See here, we are trying to find the business income. Now, when we are trying to find the business income, definitely we have to exclude income from other heads. Suppose if there is rent from house property credited to profit and loss account, that rent from house property is an income, but it has to be taken under the head house property income. Suppose there is interest on savings bank account. That interest on savings bank account is taxable under the head other sources. Suppose there is any short-term or long-term capital gain credited to profit and loss account. That short-term or long-term capital gain will be taxable under the head capital gain. So, if on the credit side of profit and loss account, if there are any incomes shown and if such incomes are taxable under other heads, not under business head, then such incomes must be deducted, because our objective is to find taxable business income. So incomes from any other heads, taxable under other heads, if it is credited to profit and loss account, then it must be deducted. The next item that must be deducted is expenses allowed but not debited to profit and loss account. Let's imagine business has paid GST, goods and service tax. Now GST is a regular business expense, but though the business has paid GST, say GST amount is given as an adjustment, it is not debited to profit and loss account as an expense. That means expense of the business has been left out. So what do we do? If any expenses which are allowed and if they are not debited to profit and loss account, then such expenses must be deducted to arrive at business income. So expenses allowed but not debited to profit and loss account must be deducted. And finally, last item which has to be deducted is the reverse of this, overvaluation of closing stock. When you overvalue closing stock, profit increases. When you undervalue opening stock, the profit increases. So if in the problem there is a mention of overvaluation of closing stock and undervaluation of opening stock, then such values must be deducted. So we add this head, 3 heads income over here, we add it together and we record it in the outer column and we deduct it from this particular income to arrive at what is called as taxable income. So these are the basic headings that we consider in computation of business income. Profit taken as starting point, loss if it exists, then it will be shown in brackets. Then we have 4 items added: expenses disallowed but debited to profit and loss account, expenses allowed but debited in excess, taxable incomes earned but not credited to profit and loss account, and undervaluation of closing stock and overvaluation of opening stock, if it exists, must be added. Then we deduct incomes either exempt from tax or taxable under other heads, not under business head, if credited to be deducted. Then expenses are allowed, but those expenses are not debited to profit and loss account. It is given outside. So such expenses, business related, must be deducted. Then if there is overvaluation of closing stock or undervaluation of opening stock resulting in increase in profit, then such amounts must be deducted to arrive at the correct value of profit, and that will give us the taxable business income. So that is about the format for computation of business income, a very, very important concept which everyone has to understand to successfully solve problems under the head business and profession income. Thank you.